All right, everybody, how you doing? It is Tuesday, January 17th. Had a little bit of a long weekend there. I hope everybody enjoyed it. So today, kind of a weird day. Dow Jones was down hard, about 400 points. Everything else was basically flat. The selling in Dow Jones, at least from what I saw online, it was the Goldman earnings. Goldman stock got hit because they took a charge on earnings. I'll tell you, folks, I don't really pay attention to earnings, and I'll tell you why in a second. I really think they're lagging indicators. For example, I remember, what was it, like the second quarter or the third quarter of last year when, they downgraded JP Morgan on some, what was at the time considered to be disappointing earnings. And I remember, like, that was put out there everywhere from Wall Street, from the analysts. This is a downgrade. The stock, they sold the stock down to 105. That was the low. And I was sending out emails back then telling my subscribers, you got to buy into this. You got to buy into this. If it was as easy as going along with earnings reports, then, we'd all be gazillionaires. Again, you got to look forward. The whole key to this game is looking ahead. I've used the analogy before of a sailor, somebody on the open seas, on the high seas. You got to chart your course to where you're going. You gotta know what conditions are going to be like in front of you. Is there going to be good weather? Is there going to be a storm? Are there reefs up ahead or things you got to navigate around? You have to look forward. And this whole business about jumping on these earnings reports, and believe me, the other thing is that a lot of people have inside information on this. Don't kid yourself. A lot of people have inside information. They know what the report's going to be. So, you're just getting, if you try to do that, or if you react like that, you're just getting caught up in their game. You're like a mouse in a mousetrap that just got caught in a mousetrap. I don't think of myself as a mouse. I think of myself as a wolf, as a predator. And, I like to eat the prey. I don't like to be the prey. Now, how do you put yourself in that position as a small investor? You put yourself in that position by being as macro as you can possibly stand. I've given you so many times I've spoken about my days as a floor trader where you would not be able to compete with me or the other guys on the floor who are there instantaneously, and we see what's going on. Not just the order flow, but the emotion and everything. All of that stuff was information. It was very, very important information, and you couldn't get any more real time than that. And that's, there are people out there now who have kind of that kind of information, even though the floor, open outcry, that doesn't exist anymore. But a lot of these algorithms, they see the orders, they jump in front of it. People on Wall Street who are inside, they know what these earnings reports are going to be. So if you play that game, you're just getting caught up in their trap. You are their prey. You got to be the wolf. You got to be the predator. And the way to do that is to take, like I said, as macro a view as you possibly can. Now, it's tough for some people because, everybody wants money like now. They want it yesterday. Like, I want money. I want to make $1 million tomorrow, right? I want to hit the lottery. This is just human nature. In a way, it's fighting against your own human nature to have patience and to stick with a macro view and to understand that it's going to take some time, but that's a growth function. It's a growth. Your progress will be a growth function if you're disciplined and you follow the rules, and those rules being focus on the fundamentals, stay away from the headlines, except if you're going to use them to your advantage. That's another way you can be a predator, is like when everybody's selling. And I think today was probably but just FYI, I sent out an email to my subscribers saying that buy the bank stocks that were hit down. I mean, think about the bank stocks. Just think about that. The Fed is giving the banks $650 million a day. A day. That's just going to pile up as their capital. You're literally increasing the bank's net worth. That's the wealth. Net worth, the definition of wealth. Assets minus liabilities. Like I've said before, if you have a neighbor, whatever business he's in, it doesn't matter, but you see this guy keeps getting wealthier and wealthier. He starts off with the same kind of house as you. Then he adds an addition on the house. First he started off with just some beat up old SUV. All right, then he gets a Mercedes. Then he gets a Lamborghini. Then he sells his house and moves to the richest neighborhood in town. Then he gets a private jet. I mean, would you want to short that guy? Assuming everything he's doing is legit, right? Would you want to short that guy? I mean, you say, I want to ride on his coattails, or I want to do what he's doing. If I could have, the ability to kind of go along with him in his gains of wealth. Well, it's exactly what's happening with the banks right now. It's free money. The Fed's just handing them free money. It's not like that's going to stop because of the debt ceiling. That has nothing to do with the debt ceiling. The Fed could pay that money. And by the way, we all know the Fed is running at negative equity, negative cash flow, but it doesn't matter. It's the Fed. It's a central bank. It could do that. It's going to keep paying the interest. So I think there was one analyst today, a friend of mine told me, I think maybe it was Piper Jaffray or something, he said, sell the banks. I'm like, sell the banks? I mean, that's going to go down. I think that's one of these calls that, bank stocks have gone up and he's just looking at price. Price doesn't tell you anything, folks. Price doesn't tell you anything. There's that old story, Warren Buffett used to tell this story that he learned from his famous professor, Benjamin Graham, when he was a student, an MBA student at Columbia University, Buffett was. And Graham used to tell the story, or Buffett used to tell the story, I forgot who, but one of them was telling the story about Mr. Market. Mr. Market comes and knocks on your door every day with a basket full of stocks, and he says, you can have these stocks at, such and such a price, at price X. The next day he comes back and he knocks on your door and, now he offers them at a different price, maybe 20% lower, but the same stocks, the same fundamentals. What are you going to do? You're going to buy them, right? Or the next day he comes around, he offers the same basket of stocks and they're 50% higher for no reason. You're not going to chase after that. But oddly, that's what a lot of people do. I had a subscriber for a long time, and she was getting like an amazing subscription rate. It was my original subscription rate of $70. And I think it was back in October, which by the way was the market bottom. She said, well, I'm going to cancel. I said, why are you going to cancel? You got the best rate that there ever was. I mean, it's basically free for the information you're getting. And she's like, well, I'm going to wait until I see, my stocks start to go up again. What kind of strategy is that? I mean, that's exactly what I'm talking about, this kind of mentality. It's so pervasive among the mass of investors. Like, think about that for a second. I'm going to wait. So, like, I said, do you wait to when you go shopping until the prices get higher before you buy? And even if you can't buy when prices are down, are you selling everything out? I mean, it's just, think about it in terms of our everyday consumption patterns. Don't think about investments. Don't think about stocks. Think about it in terms of our everyday consumption patterns. Do you rush out and buy your favorite item, whatever it is, clothing, a watch, an automobile, when they put prices up? Or do you wait around for a sale? Do you wait around for a sale? When the department stores or whatever, Amazon offers sales, that's an enticement. And savvy Savvy investors do the same thing. They wait for a sale. And there are lots of stocks that are on sale that don't necessarily have negative fundamentals. They have positive fundamentals. But when you're within a macro, I wouldn't even say a macro environment, when you're in a psychological environment, all right, I've talked about this a number of times. When you're in a psychological environment where everybody is pessimistic and everybody is bearish, I mean, that's Mr. Market knocking on your door with that bushel basket full of stocks at a very discounted price. So what are you going to say? Get out of here? Get the hell out of here? I don't want that? No, you don't do that. You don't do that. So we'll see what happens. Anyway, today's sell-off to me was very suspect in the Dow. You know, it came on a day right after the holiday. Yesterday we had the holiday here in the States, Martin Luther King. So it could have been thin trading too. We'll see how it develops over the week. Tomorrow is a Social Security payment. It should be a positive day. Flows are looking good. The debt ceiling, supposedly we're going to hit it on Thursday. Now, I've seen a lot of headlines now focused on the debt ceiling and how that's, you know, kind of like a ticking time bomb for the market. But I want you to understand that, and I've said this before, that given the balance in the TGA and anticipated tax receipts that are going to be coming in March and April, and what Yellen can do in terms of utilizing Treasury extraordinary measures, that's what it's called, that basically when Treasury's not making payments into certain government worker pension funds, I think she could, you know, continue, they could continue payments out until June. Now, I thought it would be all the way through September, through the end of the fiscal year. I'm not so sure about that, but I'm pretty sure it was said, and I think it actually even came from Treasury, that it's going to be okay through June. So, but still, don't forget, remember, I've been telling you, February 15th, that's going to be the peak in the fiscal flows, but the peak now is going to be much higher than prior peaks. We're actually on an ascending trend in the fiscal flows. But you got to pay attention to that, because then we get into the two big tax drain months. We get back-to-back. March 15th is the quarterly corporate tax drain, and the dreaded April 15th. Anyway, that's it for today. I'm putting my email on the description below. If you want to get on my email list, you know, I'll send you updates on things that are coming up or things I might be seeing or whatever. Send me an email and just say I want to be on the email list, and I'll put you on it. All right, that's it for today, everybody. Take care. Bye.